Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending August 27, 2021. I'm Preston Brent. Thanks for tuning in. This week's theme is Happy Fed, Happy Market. And we certainly got a dose of that this past Friday. So let's go in and just kind of take a look and summarize last week, just kind of set the stage for where we could possibly go here as we get into the chart. So let's take a look at the index performance first. You can see everybody in the US was clearly in the green, solid in the green. Year to date, everybody double digits in the green, with the S&P leading the way up a whopping 20%. Now, keep in mind, a lot of this is due to the big stimulus and the rebound off the COVID lows from last year, but most of the markets are aware of that. Best performing sector, completely the opposite of last week, where utilities was the best and energy was the worst. Now this week we got energy the best, utilities the worst. Okay, energy came in at a whopping 7.45%. It was enough to move the annual sector performance year to date for the energy back in first place again, leading the way at 32.83%. Looking at the PE ratios, the forward PE ratio is still pretty stretched. Now keep in mind the decade average is around 16. We're at 22.26, primarily due to the low interest rates, the way you calculate PE ratios in the math. But it's still very high, right? If you look at the dividend yield, it's at 1.31%. The 10-year Treasury surpassed the dividend yield. It's higher by, almost, let's just call it even right now. Current VIX fell 11.69% for the week. It closed out the week at 16.39. The prior week it was up 18.56%. So generally, all in all, it was a fairly good week for the markets. And of course, if we look at the economic data for the week, you can see that, we had a number of things hit, right? To start off the week, we had the FDA that here in the US approved the Pfizer vaccine, so that helped sentiment. And then this past week on Thursday, we had a little bit of a negative to the markets when we had the explosion right outside the Kabul airport in Afghanistan. That kind of soured the mood. But then Power Ranger Boom Boom Powell gave the markets a strong boost in sentiment on Friday. Basically, his key statement, and which is all the things the markets were wanting to hear, he was essentially saying that the timing and pace of the coming reduction in asset purchases, remember, they're purchasing 120 billion a month, right? 80 billion in treasuries, 40 billion in mortgage-backed securities. So they're keeping the interest rates low on the mortgage market, and they're keeping interest rates low in the bond treasury market. Everything is low. But he said that the timing and pace of the reduction in the asset purchases, typically we call quantitative tightening, is not intended to carry a direct signal regarding the timing of the interest rate liftoff. So essentially, the market's got the best of both worlds, kind of a Pollyannish Cinderella type Goldilocks market, right? So the markets were expecting the tapering to begin the end of this year, early next year, and that's kind of what Boom Boom Powell was saying. However, the markets had the fear of interest rates starting to go higher sooner. And when Boom Boom Powell said these two were independent, the markets took off. Price action essentially loved that comment. And this past Friday, the race was on for record highs, as we saw in both the S&P and Nasdaq. That's why I said happy Fed, happy market. That's kind of where we are. On the economic data front, we got some positive news generally. July existing home sales up 2% from the prior month, right? Weekly jobless claims ticked up a little bit, but still near the pandemic lows. So it does show the labor market is tightening a little bit. The second quarter GDP was revised a little bit higher to 6.6% from the first pass of 6.5. So from an economic standpoint, things were looking good. And as I said about the US Treasuries, total negative returns, the yield increased a little bit for the week. But essentially, the bond market, while the improving sentiment is towards riskier assets like equities and so forth, the bond yields are kind of settling into ranges that do not appear to be consistent, in my mind, with a rapidly growing moderately inflating economy. Now, I believe interest rates are going to be higher as we move through the rest of this year. But right now, the bond market is bought off on the transitory nature of inflation, right? But I do believe even if inflation has got some sticky components like wage hikes and things like that, and some non-sticky Teflon coated where it kind of slides right off kind of component like some of the supply chain issues, I think inflation will come down, but it's going to stay elevated. I suspect it's going to force the Feds to start hiking rates sooner than they anticipated. That's going to cause a market moving event. But I don't see that happening this year. All right. I see probably sometime in the summertime of next year, we're going to have some really good moves. I think before the end of this year, we can see a 5 to 10% pullback. Just basically noise in the market. And it's going to allow the buy the dip crowd to really jump in again pretty strong. So that's kind of what I'm looking at. Now, of course, we go over to Europe. Eurozone is still in an expansion mode. We're getting, this past week we got all the PMI data out of there. It came across at 59.5. That's pretty strong. And they had a 15-year high the prior month in July at 60.2, but still really strong. Remember, anything over 50 is a strong expansionary mode. So we're getting that in Europe. Meanwhile, in the UK, their PMI numbers came down to 55 from 59 in July. So they're pulling back just a little bit, but still in expansionary mode, both in the UK and across the Eurozone economy. Okay, so that's pretty strong. And then, of course, if we slip over and we look at the well, before we go in the Asian markets, you can see here in Europe, everything finished solidly in the green. The Euro stocks, the FTSE, the CAC 40, the DAX, everything solid in the green, and also double-digit year-to-date as well. The CAC 40 is just slightly ahead of the US S&P, up 20.36%. Very strong finish for the week. And then, of course, if we come over to the Asian markets, first of all, the Japanese government, they're extending their COVID lockdown. So they're having more, they don't have them states, they call them prefectures. They're shutting them down through the middle of September, locking them up. So that's going to affect their economy. Remember, they're the third largest economy worldwide behind China, number 2, and the US, number 1. But their services sector shrank the fastest pace they've seen since last May, this past August, and their business activity gauge fell again. So they're having some issues with all these lockdowns that are going on over there. While their manufacturing PMI is still above 50, it fell a little bit in the month of July. So they're having a little bit of a slowdown. If you look at their performance year to date, the Nikkei, it's just barely above zero at 0.72 or 72 basis points. And then looking at China, Chinese markets, they continue to recover from their late July sell-off. Remember, they almost hit a bear market a few months ago, right? They're in the green, just barely. They had a strong week this week, coming in at 2.77 for the week, just barely above water. So if you look at the Nikkei, China, and Hang Seng year-to-date performance, Hang Seng is still underwater, China just barely above, and Nikkei is almost flat for the year. So they're having a tougher go of it, and that causes the EEM, the emerging markets, which has about 33 to 35% of the emerging markets is composed of Chinese stocks. They're hurting, right, year to date. And the Vanguard All World Index is also not performing. So really the best performers outside of France and parts of Europe, you've got the US just on fire. I mean, it's just with all the money and stimulus coming here, everything is on fire, very strong. What I want to do is shift the screen. Let me just take you over to the E-mini S&P 500 futures. I'm going to shift this over here like this. Let's get it over here to this screen. And you're going to see we had a very strong bullish day on Friday. You're going to see the E-mini S&P 500 futures, a daily chart, as you can see. You can see this candle here's in a bullish engulfing pattern, meaning the low of this candle was lower than the prior candle, and the high of this candle was higher than the prior candle as well, bringing us up to 45.10. Now, we may have a typical move around the 4,500 level. Keep in mind the number 5 is a key fib node, so 500. We can dance around it a little bit. Typically, when you move through these kind of things, I almost can promise you we'll have a retest of the 4,500. So assuming that's the 4,500 level, sometimes you'll come up, move through it, and you may retest it. You may move up, you may come down a little bit more, retest it, come down, and then away we go, right? And then we take out that high here. People that are swing trading will use these pivot points. This is an existing pivot point right here, which would be that high point right there. Or if we come down in this fashion here and then we shoot up again, when you take out these levels, that's where money that missed this rain dance here will typically jump in, right? Now that's one scenario that can happen. Another scenario that would suggest more chop in the markets is, and let me just get this off the screen here so I can show you a little bit better. Another scenario is we come up through it right here, and then we come down, we test it, we attempt to rally, we come down, and then we attempt to come back up. We fail, we come down and we take out that prior pivot low underneath the 4,500. If we take that out, that becomes the new resistance point, and then we can be in a chop mode here for a while as the markets rest and consolidate gains. Remember, we were down here only about 7 trading days ago, right? We were down at 43.47. And in 7 trading days, we hit a high of 45.10. And if you do the math, you're looking at, on that distance here, in just 7 trading days, 163 points, right? So it shows a lot of built up move here. And if we divide it off these lows, right, of 43.47 right there, that's about a 3.7% move higher in 7 trading days. So that's a big move for an index, especially the S&P with 500 stocks in it. So that does suggest that we may have some follow-through momentum earlier in the week, but we'll probably find ourselves coming back and testing the 4,500, possibly running a pattern like that or the other one I showed you, because we're going to dance. We're going to do this rain dance around 4,500 level. And the next level up is going to be 4,550 sitting right here. Okay. So that's a little bit about what I'm seeing in this market. Now, as I've told you guys and our members, the buy the dip crowd is very active. We're going to get the first test of that when we do come back down and test the 50 EMA. Now, we could see that in September. Keep in mind there is a stealth thing moving through the markets right now, and it's probably not a correct statement. It's moving through Congress. That would be the U.S. Congress and the U.S. Senate. For those of you that are non-U.S. based watching this, or those that are U.S. based that are tracking it, right? What I'm talking about, excuse me, is the debt ceiling limit. Republicans are fired up now with all the mishandling of the exit out of Afghanistan. So they're feeling more empowered. And Sippy Cup Joe has lost a lot of his support in the Senate and in Congress right now. So what's coming up is the U.S. budget deficit. Now, they've passed a lot of spending bills, but it's got to get through the Senate. So the Republicans may use their weight, and they cannot use the reconciliation process the Democrats can to get the 3.5 trillion spending bill through. So the Republicans could hold that up, as well as the normal infrastructure bill, by saying, unless we see additional cuts, spending cuts over here, then we're not going to pay more over there, right? So the last time we had this, and it was the Democrats that held out a little bit, but then they came to the table. The last time, the big time, was the Republicans, and the markets literally fell about 7%, 7 or 8%. So that is due to tee off October 1st, which means in the month of September, coming up after a big holiday weekend next weekend for U.S. markets. Remember, the markets will be closed on Monday. Not this coming Monday, but the next Monday in the U.S. market, so everything will be shut down. But when all the politicians, all these idiots come back from not being in, and they come back into their seats again, that's going to be one of the top of the list things. And there's going to be a battle royale, right? So that can be one of these things that just sneaks right up on the markets. Now, any pullback is going to be a buy the dip moment. Okay, we're still in a bullish mode. We do have a Cinderella or a Goldilocks market where we've got a very supportive Fed. And by the way, Jerome Powell, and I like to call him Jerome Power Ranger Boom Boom Powell, big long name, but it fits. Boom Boom is going to be up for a new term in February. So I suspect Biden, Sippy Cup, is going to want to keep him in because better the devil you know than the devil you don't. He's very dovish. You've got Aunt B, Janet Aunt B Yellen as the Treasury Secretary. So you've got two very dovish people. I think what's going to happen is they're going to overdo it in the dovishness side, and we're going to have some inflation running hotter than people think. And the market's going to underestimate how quick interest rates are going to start to have to be brought in and moved up a little bit for liftoff due to higher inflation. But that's not on the worry list right now. It's not even on the punch list. So I do believe we're going to remain bullish for a while. I've seen new estimates for year end. Morgan Stanley came out and gave, or JP Morgan came out with a year end estimate of 4,900. Others are saying 4,800. If you remember my original estimate going back when we were down in the low 3,000 area, I said 41 to 43, and that seemed far-fetched, and now we're well above that. Okay, so that's kind of where we're sitting. I believe that the year end is going to bring us around 4,600 to 4,650, but not without a little bit of tempest in a teapot. That's all it's going to be, but we could see a 5 to 10% pullback. Okay. So you can see a bullish engulfing pattern in the S&P. That's a bullish signal, and we're going to see that kind of just take off and go strong. Okay. Now, the other one that we're going to get, and then I'm going to see here is if we look at it, Nasdaq also made all-time highs as well, right? I mean, if I find Nasdaq on here, you're going to see Nasdaq came in. And it also had a bullish engulfing pattern as well. And it also made new all-time highs, right? 15,443.75. So we've got all of these set up here. But again, the higher we go, the more stretched we become. You can see the MACD showing what I call a good poor man's bed setup. And for our members, you know what I'm talking about here. So I could see this thing coming back into this wider zone here. And again, we are in a buy the dip mode, but I do expect a dip coming. So that's a little bit about what I've got here. Now, if we look at the Dow, they did not make new all-time highs. The Dow futures did not make new all-time highs, as you can see right here. Last all-time high in the Dow futures was back about the middle of August of the 16th, okay, about 12 calendar days ago. But I do believe that it'll probably come back down and test the 50 EMA, and we'll look at a buy the dip moment, see how that works itself out there. But the one that had the biggest move for the day was the Russell futures, right? If we look at the Russell futures on here, and let me just find it on my screen. Let's see, where are we here? I know you're on here. How about we do it this way? Let's sort it this way, like this. So if we look at the Russell futures right here, it was up 66 points for the day. Look at that candle. It was a bullish engulfing, but we also took out prior pivot highs. All right, and we're challenging this pivot high here. We're still now in the shaded zone. And I did say we're going to break this shaded zone, either to the upside or the downside. I honestly think we still have a higher opportunity of breaking the downside. But the Russell is being playing catch up to everybody else. Remember, the Russell is small cap, mid cap stocks. But one of the things people don't realize, there are a lot of banking stocks in the Russell index. And banks love the performance of the markets taking off with the possibility of higher interest rates, higher yield curves. So you're going to see the banks overperform going through the end of the year, and I think you're going to see cyclicals, you're going to see small cap doing fairly well. Now, I told our members, you know, IWM is one way to play that, but probably the better way, a little bit more volatility in it, would be TNA. TNA is the small cap 3X bull, And you can just see this bounce off the support here. And it just took off. Now, we had a bullish divergence. So we had a signal on TNA on the 23rd of August. And that would have been a signal to go long. And that was back when it was around $83 a share. Now it's 91.96. Okay. So these are just some nice plays that and I've been talking about them for a week or so with our members, but that's something that you want to really take a look at. And of course, if we come over here and look at volatility and the VIX, it fell hard on Friday, 2.45 points. You can see the VIX is still in this yellow zone. It's kind of a choppy market zone. I suspect we could, with momentum, bring it down a little bit, but then I do believe we've got some surprises in store for the month of September going into October that'll give us that little bit of a pullback. You'll see the VIX come up and challenge these mid-20 areas right here. I think we'll see that again. And we want to use these times as opportunities to buy the dip our toe in and come in and do that. If we look at the front month skew, you can see we're in the green, but not too much. Okay, this is showing the volatility skew in the futures market is still in a contango, which says there's not much fear out there. Now, if we go out to the back month, which is September, October vol futures, you can see here we're well into the green. The last time we even touched the red was back over here in May when the markets pulled back about 3.5%, 4%. All right. And we finally got into the red. But we're just, the markets are not fearful right now through the rest of this year. Now, remember, everybody knows that November, December tends to be a very strong month for the markets, and September and October is more iffy, flat line to iffy. And if we do get a dip, it's going to happen before the November timeframe. At least that's the way the markets historically have been. So the markets you're going to see the buy the dip crowd aggressively come in. Members, I'll show you the key areas that we look at to differentiate, where's a good opportunity to buy if we do get a dip. If we do get a dip, where do you want to go in? Where do you want to wait until we get that dip? All of these things kind of go into play how you want to play this. Okay. If we look at the bond market, now, even though the bonds moved up a little bit on Friday, notice the 50 EMA is providing the support. Once that 50 EMA is broached to the downside, which I believe it will be, it's gonna move down fairly quickly, and we're gonna see interest rates move up. Because if we look at the 10-year interest rate, it closed the week, as I said, at 1.312. You can see how it's having trouble maintaining the 50 EMA. The minute we get above the 50 EMA and hold it, we're off, and I believe at the end of the year we should be north of 1617. I do believe. In fact, the Elliott wave forecast is calling for the interest rates to get up over 1.9. Okay, so it could be a real interesting time. Now, this could be an elongated Elliott wave 4 pattern where we go into chop for a while, but I do believe the lows that were made back here in early August around 1.13 have pretty much been set for this year. Okay. And then I think we could, worst case, come down, chop around, but I think longer term interest rates are going to go higher. All right. And for our members, I've shown you ways that we're going to be playing this and how we're going to move around that. Okay. And of course, if we look at the currency market, right, and we look at what's going on in currencies, the dollar, I do believe longer term, the dollar is going to go lower. It's going to come down, test the 50 EMA, as you can see here. Now, here we had the overlap of 50 and 200. And with the 50 moving above the 200, that tends to be a bullish sign, right? Remember, if we get that dip in the markets where we do a 5 to 10% pullback, and we may not even get 10%, we may get 5, 7%, something like that. If we get that kind of pullback, you'll see the dollar get stronger. And then if it gets stronger, that's a good shorting opportunity, because what you want to do is get into the euro to the long side. You can see how the euro is coming down. You've got a nice poor man's bud firing off right here. And it fired off on the 23rd of August. Okay. And we've moved up a little bit since then. I think it's going to run up and challenge the 50 EMA, probably run sideways a little bit. You can see the 50 EMA move below the 200 EMA on the 22nd of July. So that tends to be a longer term bearish move. But until we clear these, I think the euro is going to move higher. But in Q4, possibly not, right? And if we come down and look at gold, well, gold, we're playing out longer term to the upside. I do believe gold, if I back this out, you can see this symmetrical triangle right here on gold. Right at that area there, we had a flash crash almost in gold where it moved almost 200 points in just a couple of days, but it quickly regained and went right back into the symmetrical triangle here. I think the odds favor a breakout to the upside on this kind of pattern. Okay. And I think it can run up over 2,000, at least over 2,000, and before the end of the year. Now that would require that we see the dollar pull back. We start to get more inflationary data that comes out. We're going to be getting CPI data and other data like that over the coming weeks. This coming week, on Friday, we get the unemployment number and we get the jobs number for the month of August. That'll be a big number that tends to move the markets. Not the weekly jobless claims, but the big jobs number on Friday by the Bureau of Labor Statistics. That hits. The markets are looking to have seen an added 781,000 jobs. Now remember, the prior month, it was real strong. We added 943,000 jobs, okay? But I think it's going to come in a little bit less than that. And the expectation for the unemployment rate is to come from 5.4 down to 5.2%. Still elevated in the Fed's mind. But that's a big number coming out this next Friday that we should see. But anyway, with gold, longer term, we're playing it bullish. Same thing with silver. Copper, I think copper is going to be a great metal longer term through 2022. And there are a lot of reasons for it, but you can see this. We got long copper way back over here in early April, and we've just ridden it all the way up. I had a list of 10 assets that you need to be long in the second week of April. And a lot of our members just took them and just went with them, and it's just been a great run. But now it's a little bit, after a long run, you've got to have a long period of consolidation before we move again. And you can see this trend line was finally broken on the middle of August. And now we're coming up and we're doing a retest of this trend line. I think eventually we're going to kind of chop around and then slowly start moving higher again. Not as steady as we did back over here coming off the pandemic, right? But I think, with the EV market taking off, it takes 40% more copper to build a car with the EV market. So there's a lot of stats out there that you can read that just show the demand for copper is going to outstrip a lot of the mining supplies. So longer term, you'll see big money just taking longer term positions in copper. There's a number of ways to trade it. Members will review that this Sunday and just kind of check where things are. Okay. And then, of course, if we look at oil, we got this big Cat 4 hurricane that's due to hit. It could shut down oil and gas wells. That always has a tendency to move oil up an additional $2 to $3 a barrel. We're getting a challenge here off these lows. Back over here, when we hit these highs, back over here in late June, I was saying fade this move. You can do it as a call condor, which would be better than a put condor, because the challenge is typically to the downside, not the upside. And a call condor, you can adjust it a little bit easier that way. Or you can just do an iron condor and do it unbalanced and just play this thing. And I said that I doubt we'll get back up over the 77 area, 80 area in oil, or go below the 60 area. And we actually hit the low here of 61.74 after that huge move lower here. All right, and we've almost done this V recovery, which tells me that we're going to get some sideways chop for a while. Some of this V recovery is due to the hurricane. So it may, after the hurricane blows through and they reopen the rigs, natural gas pipelines, all this other stuff, nat gas procedure process, then you'll see it pull back just a little bit. And speaking of nat gas, well, if we look here, you'll see here this big move. This, my friends, is what I was looking for. Now, I had suggested to fade this move here. And what I'm telling folks that trade nat gas is take your profits soon. If you get profits in 4 or 5 days, shut it down, wait a few days, and look at another one, okay? This move here is going to set us up for a nice little pullback. And the reason why nat gas is doing this is because of the hurricane. The last time we had a hurricane come over, it hit around the Houston area and it hung around and it did like this waltz around Houston and surrounding towns, and it shut down nat gas and rigs for 3 weeks. And nat gas just went through the roof, right? So a move like this is going to set us up for a bed, and this is a great opportunity to look at possible shorts. But you got to let the hurricane hit. It's due to hit Sunday evening. We'll look at the damage on Monday and just where it hits, where it goes, get the oil and gas reports, and then we'll take a look at a possible play in that. Members, we'll look at that on Monday, Tuesday timeframe. Okay. All right, everybody, that's kind of where we're sitting right now. Members, I'll see you tomorrow evening for our weekly market watch. Everybody else have a really great weekend. For those of you, especially our members, if you're down in the southeast in the Louisiana, northeastern part of Texas or Mississippi area, just be careful. Got strong winds coming through. Have a great weekend, everybody. I'll see you tomorrow evening for our weekly market watch. Take care, folks. Ciao now.